First of all, I want to thank everyone for coming out today. We truly appreciate it, and I'm glad we all did. Traffic was insanely light for me, and it sounds like for a lot of people also. They had great experiences, which is unusual, but a good way to start the week. Wanted to welcome you to the Singer Lee Wax Nonprofit Academy. It's a series we're going to be putting on. Nonprofits are important to our firm. It's one of the key industry groups within our firm, and there's some unique challenges, and this was a great opportunity for us to be proactive. There's a lot of changes that are coming down the pipeline we wanted you to be aware of, so we invited Jeff Mechanick from the FASB to come up and address this. So he flew out from Connecticut last night, and he's flying back this afternoon. So he's here just for us. And the great thing about it is, like I've told some of you, any feedback that you have, you may like some things about Nonprofit Gap. You might think some things need to change. His phone number, his email's up there on the board. You could email him later if you want. You could bring it up. Just let him know. The FASB takes feedback all the time, and they noodle on it, and if they can see where changes need to be made, that's how ASUs come out a lot of the time. So I'll welcome Jeff up to the stage. His background is 25 plus years in accounting. He's been with the FASB for 11 years. I've known him now for about 6 or 7 years. His passion is nonprofits. He also works with the private company agenda as well, and trying to basically add a little bit of sanity to the process so that at the end of the day, the standards that all of us have to either prepare or audit are ones that kind of are easy to apply. So with that, I'll welcome up Jeff.
Thanks, appreciate that. So, good, can you hear me all? Awesome. So, what was I say? So thanks for that great introduction, Jeremy. What Jeremy may not know, or left out, just to let you know that I'm one of you guys too. Prior to coming to the FASB now 11 years ago, those of you who are in public accounting, I was with a public accounting firm, KPMG. But at least as importantly, I was for 10 years, I was the Chief Financial Officer of Planned Parenthood Federation of America. So I know many of you, especially out here on the West Coast, like where I am in the East Coast, are very supportive of that organization, which is a political football every 4 years. Was that way when I was there, still is that way, as you guys know. But I've lived in your shoes, I've walked your walk and all that sort of stuff, and so I have a great appreciation for all the great stuff that you guys do in the not-for-profit sector and in serving clients in the not-for-profit sector. And I'm really pleased that Singer Lee Wax, and I now know how to pronounce it, Singer Lee Wax invited me out here, so thank you. So for the next roughly hour, but I am going to try to leave at least 10 minutes for Q&A, and I'll hang around a little bit after that. And again, as Jeremy said, you have my contact information as well. I'm going to talk about stuff coming down the pike, change that you will need to implement or help your clients implement. And I'll be glad to point out a few key things here and there and answer questions and so on. I'll also tell you as part of this about an important project that we have on our current agenda where I'll want you guys to weigh in on as when we put it out for public comment this summer. Before I begin, however, I do need to give this wonderful gobbledygook disclaimer that anyone speaking on behalf of the Financial Accounting Standards Board, or FASB, must say, and it's in that really small italic print that we have at the bottom. It says, the views expressed in this presentation are those of the presenter. Official positions of FASB are reached only after extensive due process and deliberations. What that basically says in plain English is that I am not setting GAAP here, generally accepted accounting principles, by anything that I say. I'm just trying to give you my best perspective on what's going on and how it might affect yourselves, your organizations, and your clients in the coming months and years. Okay, so I'm going to cover these things. I'm going to talk about the ASU that we put out last year to do targeted improvements to the 20-year-old not-for-profit financial statement model. That'll be the first part. Then I'm going to talk about that important project that I mentioned earlier that we're going to be going out to for public exposure on, and that is the project on grants and contracts to not-for-profit organizations. I'll talk about why we're doing the project and just the general thrust of where we're heading with that project, again, subject to public comment. I will then talk a little bit about some other key changes that you may have been hearing about over the last few years, give you a few pointers here and there Two standards in particular affect many not-for-profit organizations, just like they affect many private companies and many public companies, and those are the standards on revenue recognition for contracts with customers, and not-for-profits do have customers, it's not just donors and all, and leases. And then I'll talk very briefly about a few other standards, more for just awareness that could affect your organizations and your clients to different degrees. So a lot to cover. Again, I'm going to necessarily be a little bit overview-ish here, but I will dive in on a few key points here and there. So the first one that I want to talk about is our not-for-profit financial statement project, or ASU 2016-14. This project actually came about as a result of recommendations that were given to it by our not-for-profit advisory committee, which I actually chair on behalf of the FASB. It's a group of about 20 people from all sorts of different not-for-profit organizations, audit firms, people who use financial statements like foundation grantors, bank lenders, and others, who are interested in good financial reporting by not-for-profit organizations and who have a direct ear into the FASB through this advisory committee. When that group started meeting I guess it's about 6-7 years ago, I had actually talked the FASB into recreating this type of a group. They had a bunch of suggestions on areas that the FASB should focus on with regard to GAAP for not-for-profit organizations, and many of them coalesced around trying to make some targeted improvements to the then 20-year-old not-for-profit financial statement model that was created back in the 1990s, and now it's actually close to 25 years ago almost since that thing was created. And the areas that they asked us particularly to look at were some of the net asset classes in lieu of the changing endowment laws and other things that have happened over the years. To look at the way that financial information is in the balance sheet, the statement of activities, and the cash flow statement to see if we can do some things there to make it a little clearer, a little better. Particularly in some targeted areas around liquidity and assessing how liquid a not-for-profit organizations are there things that are preventing it from paying its bills? Are there things that have been attached to some of the monies that have been given to us that might not be otherwise apparent from looking at the financial statements? And a few other key questions like that. And doing some other things that in general might help the not-for-profit to tell its financial story through its financial statements. This project, we actually put out a comprehensive proposal on back in 2015. And as a result of the feedback that we got from the public, we ended up phasing this project into two pieces. So most of the areas that we were looking at, we made some tweaks here and there to those areas of net asset classes, reporting of expenses and investment return, trying to better understand liquidity and availability of resources, and a couple other things. We were able to finalize in this standard ASU 2016-14 that we put out a year later. But there were some other areas that were more controversial or areas that were arguably more dependent on some of the other things that we were working on behalf of business entities and so on, around operating measures and related rated changes to sync up the cash flow statement a little bit better with the statement of activities that we've for now put on hold. We will see when and if we get back to them. You have enough other things to implement in terms of targeted improvements with this ASU. And in the meantime, as I mentioned before, we're working on a very important project on grants and contracts to not-for-profit organizations. So what were some of the changes that we ended up making to the not-for-profit financial statement model? Well, the first of those has to do with the statement of cash flows, which is the statement that's really used the least in a not-for-profit context, which is a shame, which it could actually tell you a bit. But unfortunately, many people out there look at the cash flow statement sort of as a necessary evil as opposed to something that actually could be useful. So what we tried to do there to maybe encourage people a little bit, but not mandate that they use the direct method of reporting operating cash flows, is we took away the requirement to do the indirect method reconciliation if you choose to do the direct method. I'm going to illustrate that in a minute so you know what I'm talking about. We hope that allowing this true free choice that you can either do the direct method or the indirect method, but if you do the direct method, you no longer have to do that indirect method reconciliation, might push people a little bit more towards using what we think is the more intuitive approach, which is the direct method approach. Okay, here's what I mean by that. So if you look at the operating cash flow statement section of a cash flow statement, the other sections, the financing and investing section, look the same, but in the operating section, it looks different depending on whether you're using the direct method or the indirect method. The direct method has all of the different key cash inflows, the different receipt categories that you get during the year, and then the different outflows or payment categories that you have during the year. So for a common not-for-profit organization, you'd have cash received from donors, you'd have cash received from program fees, you might have other types of revenue that come in that you show on different lines. And then where does the money go out the door? It goes out the door, cash payments to employees, for salary and benefits and so forth, cash payments to your vendors. You might, depending, especially if it's a large number, you might have a separate line for cash payment for interest on your loans and so on. These are much more similar in many ways to the types of information that you have during the course of the year that management gives to its board, cash flow projections and so forth. But many people have, over the years, shied away from that, either because they thought they had to put in all new systems to be able to capture that information, or because they were stuck anyway doing the indirect method, and why do double the work? The indirect method takes as its starting point the change in all net assets, so that's all of your basically revenue, expenses, and everything else together that increases your wealth. That's what the starting point is, and then it backs out different non-cash items like depreciation and amortization, which again, that in and of itself might be useful information, but it also then backs in and out the changes in some of the different assets and liabilities, and eventually gets you to the same number that the direct method gets you to, but in a way that maybe while providing some useful information, I would argue at least, doesn't give you the kind of good intuitive information that you can look at for trends year to year. Because, like, for example, you might have, you might be getting grants from your state or local government, and sometimes, as we all know, the state and local governments could be a little bit slow paying. It is a lot easier sometimes to be able to eyeball your activity statement and seeing what kind of revenues you're recognizing for those state grants, and then comparing it to the trends in the cash receipts and how those differ. And that might tell you some really valuable information compared to trying to figure out, okay, looking at the grants or pledge payable numbers going up or down and trying to figure out what is that really telling me. So again, the hope here is by allowing true free choice, that if you choose to do that direct method, you don't have to do the indirect method as well. We hope that people will go more towards the direct method, but again, we're not mandating that. We don't mandate it for business enterprises. We're not mandating it for not-for-profit organizations either. Okay? So that's the first change. The second targeted change that we made has to do with the net asset classes or equity classes or wealth classes of a not-for-profit organizations. Up until now, we've had, since the model was put into place 20 years ago, we've had 3 net asset classes for a not-for-profit organization: unrestricted net assets, temporarily restricted net assets, and permanently restricted net assets. And which net asset or equity class you put resources into on your financial statements, which one you bucket it into, depends on whether or not you have a donor restrictions associated with it, donor or grantor restriction, and the nature of those restrictions, whether they are of a temporary nature, that they'll be spent for programs or whatever, or a permanent nature, they would be invested in your endowment. But the problems are that it doesn't really say donor or grantor related, it says just unrestricted, and that's caused a lot of confusion over the years. There could be all kinds of other legal restrictions associated with some of the resources that you receive. And temporarily restricted versus permanently restricted worked really well under the old endowment laws, but with UPMIFA, the Uniform Prudent Management of Institutional Funds Act, which California, along with like 48 other states, have adopted, that split is not as neat as it used to be, and it doesn't, frankly, make a lot of sense anymore. So we're actually using the opportunity to rename, streamline, and maybe open the door for some other better, more useful breakouts of your net assets or your equity classes, and I'll illustrate a little bit of that in a minute. So going forward, you have 2 net asset classes at a minimum, and again, you can break out below them, and I'll illustrate that. Net assets with donor restrictions, and net assets without donor restrictions. And donor does include certain types of grantors as well. And similar to the way there is now, to the extent that you don't describe the types of the broad classes of donor restrictions, you do have to do that in the notes to your financial statement. So you might do some breakout on your balance sheet. To the extent that isn't sufficient, you would also do some more information in your notes. Where we have extended the requirement and actually basically emulated best practices out there is on the unrestricted or without donor restrictions piece. You would now, going forward, either on the face of the balance sheet or in the notes to the financial statements, describe the broad classes of board designations, where you've set aside money for different types of things that would be important for a reader of the financial statements to know. So let me go and illustrate that just a little bit, but before I do that, I do want to Actually, I can do that right now, and then I'm going to come back to a couple other things. So your balance sheet. Net asset classes, as I was talking about. Right now, current GAAP, you have unrestricted net assets, temporarily restricted net assets, and permanently restricted net assets. Going forward, the minimum requirement, which is in the middle column, and the reclassification is the new GAAP, which is the final column, is you would have net assets without donor restrictions, which is generally going to be what your unrestricted amount was, and your net assets with donor restrictions, which is generally going to be the combination of what's in temporarily and permanently restricted net assets. Now, if you notice this really well, you will see that it's not a nice simple translation here. You will see that unrestricted is 23,237,000 or 23,237. I guess it doesn't say in thousands there. And you'll see when you go to net assets without donor restrictions, it's 125,056 as opposed to 23,237. There's a reason for that, and I'm going to come back to that in a moment. Same thing with the combination of temporarily and permanently restricted net assets. The two of those don't nicely equal the amount with donor restrictions, but I'll explain that in a reason why, because it has to do with a couple other changes. But in many cases, it's just going to be renaming unrestricted and keeping the same amount, and merging together temporarily and permanently restricted, and having that amount as net assets with donor restrictions. Now, I said these are the minimum amounts the minimum requirements that you have, and that's what's illustrated in the top part of the slide. But you might want to take the opportunity to give the readers of your financial statements at least some broad idea about the general nature of the amounts with and without donor restrictions. So let's start with the one you're kind of used to breaking out or thinking about, net assets with donor restrictions. You might, for example, and this is only one way you could do it, there's many other ways, you need to think about your organization, what kind of resources you have, and what your readers would be interested in. You could break it down, for example, for stuff that doesn't have any purpose restrictions, but it's for future years. That's what we call time restricted for future periods. Versus purpose restricted, which is for your different programs, but it's earmarked for that particular program. Versus endowment fund, which is monies that in and of themselves you're investing and not spending, but the revenue, the investment return that's being generated off of that, that's what's going to fund your programs and your other activities. Similarly, for your net assets without donor restrictions, you could break it out into an undesignated piece, the piece that you haven't set aside for anything in particular, your general funds, whatever you want to call it. An operating reserve you might have. You might have put aside some money for, for use if you need it to help fund your operations, or at least to give you a cushion in terms of the cash that might come in. Or you might have it for capital projects, or you might have designated to add to your endowment, what we call a quasi-endowment or board-designated endowment. There could be all sorts of things you do. As with the net assets with donor restrictions, the net assets without donor restrictions, we're not looking for this to be fund by fund. It's more broad groups of funds. You might have a bunch of different reserve funds or designated funds. You might have a whole bunch of different purpose-restricted funds. It's just to try to capture some broad information here on the balance sheet, and to the extent you don't have sufficient information on the balance sheet, in the notes to the financial statements. Okay? And the amount that you'd put in, amount of information, would be similar to what it is now. The description of the nature and purpose of the different groups of funds that have been entrusted to you. Okay? Now, I said a little while ago that you'll notice that I didn't nice and neatly move the amount from unrestricted into without donor restrictions. It's actually off by $100,000 or $100 million, and the offset to that is in with donor restrictions. That has to do with the two places in the financial statements where we're actually changing the underlying accounting. Most of this is all about financial statement display, but there's a couple places where actually the underlying accounting and reporting changes a little bit. Now, one of them, I am, with apologies, going to tell you, I inadvertently left the slide out, but I'll tell you what was on the slide. And then the other one, we have the slide right behind it. So the one that's not on there right now has to do with the changes in the reporting of endowment funds that are underwater. And what I mean by underwater means that the amount in the endowment fund is less than the donor gave you. In the old days, you had to actually cease spending from that. You had to freeze all your spending. Under the new days, nowadays with UPMIFA, you actually can continue to spend as long as you have in place prudent spending and investment policies. But what we found was that during the financial crisis, funds that were underwater, that kind of information was useful to people out there because they were trying to get an idea about, well, okay, this not-for-profit has a bunch of money that's underwater. is the board going to take any actions there? Are they going to slow the spending, or what are they going to do there? So that was a piece of useful information, but what confused people over the years is that this underwater piece was sitting out there under unrestricted net assets, and that really are away from the rest of the endowment fund and the amount of this deficit, the amount of this underwater amount, and people were really confused about it. They were saying, does that mean that I have to immediately transfer money from my operating funds to my endowment to restore it? That wasn't even the case under the old law, never mind under the new law, but our presentation there really confused people. So going forward, you no longer would break out the underwater piece and put it separately in what would now be called without donor restriction net assets. You would keep the entire endowment amount together within net assets with donor restrictions. Now, what would we do, however, to improve the information there? It's in the area of disclosures. Right now, if you have an endowment and your endowment is $50,000 underwater, it's $50,000 less than what the donor gave you, it's a very different picture if it's $50,000 out of a gift that was $100,000 originally versus a gift that was $10 million or $100 million out of the original gift. So you have no context right now based on current GAAP and the disclosures there. Again, not on this slide, but the disclosure improvement there is for those funds that are underwater, what was the original gift amount for those funds, total for the funds together, what's the amount in the bank right now, the current fair value, and then what's the difference. So you have an idea about that context, how relatively underwater things are. There's also a disclosure there about what policies or actions a governing board takes with regard to underwater funds. Right now, under GAAP, there is a disclosure that says you have to disclose your investment and spending policies. Now, in the middle of the financial crisis, there were some good best practices out there that with some underwater funds were some of those as part of that disclosure about spending policies that were saying, well, we have some underwater funds and we have cut our spending rate from 5% to 3% temporarily or taken other actions. What we're saying here is if you have those kind of policies in place or you've taken that kind of action, put that in that note as well about your spending and investment policies. It's good information for bankers, I know there's some in the room here, and others who are trying to get a sense for, okay, what's really available, how are the programs going to end up being funded over the next few years and so on. As I said, it's good information in that context. The other area where we're changing the underlying accounting or reporting has to do with expiration of capital restrictions. Now, most not-for-profit organizations, if you're given the gift of a building or a piece of equipment or whatever, like that, a capital type item, and if it doesn't have a donor restriction as to use, it doesn't say you have to use this building for this particular purpose for the next 5 years, but it just gives you the building. There actually has been an option under GAAP to either, and this is where most do it, is they either comes in as an unrestricted gift, or what we now call net assets without donor restrictions, or you can imply a time restriction and gradually release that restriction into unrestricted over a period of time. That was something that was allowed when we went to the new model 20 years ago, but now going forward, because it doesn't cause organizations with similar gifts to appear very differently, and because, frankly, far fewer than even 10% of organizations choose to use that alternative, going forward, that alternative will no longer be allowed, okay? So let's return now to that original that balance sheet that I was showing you a little while ago. The reason that unrestricted net assets do not simply equal net assets without donor restrictions is because of a couple of things that are being done here. The two things that are being done is that the amount that would have been shown in unrestricted as a deficit, as a negative amount because the endowment fund is underwater, and that's that 1,084, is being moved, that underwater piece, from unrestricted to with donor restrictions, to be with the rest of the endowment fund. Okay, again, in return for some better disclosures. And the amount that was now sitting in temporarily restricted net assets, in this case $100,000 or $100 million and change, for amounts that they implied a time restriction that they would eventually release into unrestricted, but where there's no donor restriction involved, that amount as part of moving to this new standard would move to without donor restrictions. You would release it as part of your opening adjustments. So with those two things changed, then the amount for unrestricted becomes without donor restrictions, and the two together for temporarily and permanently restricted becomes with donor restrictions. Again, no longer being able to imply a time restriction when it doesn't exist, when the donor hasn't said, use it only for a particular purpose for a particular time, but has just said, here's a building, use it, and putting all of the underwater piece of endowment together with the rest of the endowment. Those are the two things where we've changed the underlying accounting and reporting. And with those two changes, it's just a simple otherwise translation from unrestricted to without donor restrictions, and from temporarily and permanently restricted together to be with donor restrictions. Again, we hope that by making those couple of changes, we've eliminated some confusion, promoted a little bit of better comparability across not-for-profit organizations, and tightened the terminology in terms of what was intended with regard to these net asset classes. Okay? So that's the stuff that we did with regard to net asset classes. The next area, and I have a bunch of bankers in the room right here, was one that we had particularly with you guys in mind, but it's helpful for a lot of others as well, governing boards and others who read not-for-profit financial statements. And that is, over the years, people look at not-for-profit financial statements, bankers and others, bondholders, and they look at it and they see there's these different assets that look like they have different amount of liquidity, how much can they readily be used to pay bills with, in what time frame. And they look at the obligations of a not-for-profit organization and have some idea, at least in some cases, as to when they need to be paid. And then they see this whole stuff around net asset classes and donor restrictions and all that sort of thing. And I can't tell you how many conversations I've had over the years where I've had a banker call me up or somebody from a credit rating agency call me up and say, what does all this mean? What do these donor restrictions do? Do they really affect the ability to pay bills or anything like that? What are they, okay? So what we tried to do here with the changes that we're making, and just in the area of disclosures, is to try to provide better starting point information to bankers and creditors and others who are looking at the financial statements about what really is available and what's not. We're trying to bring together the information that they would see on the balance sheet with regard to the different assets and liabilities, together with the information also on the balance sheet, but in a different part, having to do with the net asset classes, and sort of together by doing that, along with some qualitative information about lines of credit and liquidity reserves and days cash targets and whatever else a not-for-profit might be doing to manage its ability to pay bills and so on. Try to provide together some better starting point information for a not-for-profit organization to have those kind of conversations with lenders and others. So there's many different ways that you can do it. To do this, there's some qualitative information that I'm not illustrating here about some stuff you might already find in the notes to the financial statements about what kind of lines of credit we might have in place to deal with seasonal cash flows. If the balance sheet date, you have a pretty low amount of your financial assets there because that happens to be a low point cash-wise for the year, but you take care of that by having a line of credit in place to provide the ability to continue to pay bills. Well, that's good information to be disclosing. If you've similarly set up an operating reserve or that might be based on days cash targets or a percentage of your spending for the year or whatever, that's also good qualitative information to have around this. But also we're trying to provide here, in terms of what's on the balance sheet, those different assets, and we just confined this to assets. We didn't end up doing liabilities and all for a whole bunch of reasons. We didn't want to have people send false signals about going concern situations and all that sort of stuff. It's just on the financial assets on the balance sheet, which of those are associated with some things that have donor restrictions attached to it or even governing board designations attached to it. So the objective there for that for the quantitative disclosure is the amount of financial assets on the balance sheet at year end. So there's no projections involved here. It's the information that's on the balance sheet at year end, what bankers and others would be looking at. How much of that is available for general expenditures within the next year? And we took a one-year period when all was said and done here because people are used to reporting one-year periods, current assets, current liabilities, and so forth on their balance sheet. So we went with that one-year period. So in this particular case, what we're illustrating here, because of the nature of the restrictions and so forth, they've backed out all of the pieces having to do with donor restrictions and the pieces having to do with board designations and saying, okay, of that $234 million of different financial assets on the balance sheet at year end, only $5 million of it isn't tied up in all of these other different, of these specific things, earmarked for particular programs, earmarked to provide a liquidity reserve, invested in endowments, and all sorts of other things like that. Now, a very important thing that has come up since we issued this ASU and illustrated it and all and I can really relate to this having been the CFO of Planned Parenthood Federation, is that, okay, yes, you could go ahead and back out all those amounts that are restricted for particular programs. Now, the endowment stuff is truly not available other than maybe the amount you're going to appropriate for the next year into your spending policy. But the amount for the different programs, depending on how you fund your programs and what kind of restrictions you have, maybe you don't want to back those out. Now, at Planned Parenthood Federation, I was the CFO, and I used to work very closely with my development officers, my fundraising officer and all. And so we knew that with some private foundations and various major donors and so forth, they would almost by a matter of policy not give unrestricted gifts or unrestricted grants. So what would we do if we were trying to fund the program that we wanted to fund? Well, we would get them essentially to sponsor, through some general restricted monies, programs that we otherwise would be doing, okay? So, and those kind of monies, say a general grant for all of the educational activities that we did to our affiliates around the country, or for family planning assistance that we would do in the Latin American region, or whatever. These very broad type of restrictions like that for programs that we'd otherwise want to be doing. We would obviously want to raise a whole bunch of those monies, which are almost, if not every bit as good as the pure unrestricted monies, because, hey, they're funding the kind of program that we'd want to do. But those would come in through our financial statements as temporarily restricted and then be released to unrestricted as we actually spent the money. How would you want to display that on this type of a schedule? You might not want to back those monies out because you might not say that's presenting the most accurate picture. Now, we did not define what we meant by general expenditure. General expenditure you could view as just unrestricted funded expenditures, or you could view it as these broad ongoing program type expenditures. I, back in my old days, would have taken probably the latter view. So since we didn't define general expenditures, and we had some discussions at our not-for-profit advisory committee and with some of our board members about that, they all agreed pretty much that, look, as long as you're transparent about how you're looking at general expenditures and coming up with this, your disclosure, that's fine. It's good and better starting point information. So if you don't back out those restricted dollars, if they're broad restrictions, you might want to back out things that are really pretty narrow or not for the current year or whatever. As long as you say, as part of your qualitative disclosures, that we're looking at general expenditures broadly and include within general expenditures these restricted funded grants and so forth for our ongoing programs, that's fine. So you have apples to apples. Apples in terms of how you've looked at it and how you've described how you're viewing general expenditures, with apples of what you're showing on the schedule. Conversely, if you take a very narrow view because you have very narrowly earmarked type of monies that you get, then just make sure that you describe that you've taken a narrow approach to what you mean by general expenditures. Again, the goal here is to provide better starting point information for your boards, for your lenders, for others who look at your financial statements to have further discussion. And in a not-for-profit environment, unlike a public company environment, you have the ability to have those follow-up discussions. Okay? So that's what we're trying to do. And again, the qualitative disclosures about how you're viewing general expenditures and how you're managing liquidity, the lines of credit, and all that other stuff are really an important part of moving the ball forward, to use that wonderful sports metaphor, here in terms of the quality of the information that the readers of the financial statements are going to see in your statements and in your notes. Okay? Another area that we changed GAAP in, and those of you who already prepare a statement of functional expenses because you are a social service agency or another type of not-for-profit that's already required to do that under GAAP might say, well, there's no change here. But there is some change here for those who don't already prepare that. So that's a university, a hospital, a museum, a foundation, all sorts of other types of not-for-profit organizations. You do prepare sort of a statement of functional expenses as part of your 990. If you remember your 990, and I'm kind of excluding foundations here because they do a 990 PF. But in 990, you have this schedule in there, and it has some columns, and it has these rows of different types of expenses. And by the way, this is what I'm talking about here. I will move forward just for a second. Something that looks like that, right? But in your 990, you don't break apart your program services. You have it all in one column. You only have separate columns for the different support services, like management in general, fundraising, and if you're a membership organization, you might have membership development as well. But in the 990, in addition, by the way, to it being all the program in one column, it's on a legal entity basis, just like your 990 is on a legal entity basis. So if you have, let's say at Planned Parenthood, we had a 501c3 main organization, public charity. We had a 501c4 organization that did some lobbying, had a PAC within it, and so on. And we also had a related fundraising foundation, and therefore we ended up having a consolidated set of national organization financials that had all three together. None of our 990s would show that together, but in the GAAP financial statements, we would have to bring it all together here. So again, those are the two differences between what you'd see in your 990. Your 990 wouldn't break out the program stuff into separate columns, and it would be just legal entity by legal entity, which wouldn't necessarily match up with what you have in your GAAP financial statements, which is consolidated. So again, going forward, all organizations would have to provide this information, expenses by function, which is the different types of programs and the different types of support services. That's already required under GAAP somewhere in the financials, either in the notes or on the face of the statement of activities. Expenses by nature, which is how you budget things, right? Salary and benefits and travel and consulting and so forth. Again, that's actually not required right now unless you're doing a statement of functional expenses as a social service agency or voluntary health and welfare organization. And bringing the two together in many cases, what would be a matrix type format. Now, that doesn't have to be a separate statement of functional expenses. In fact, I'd argue that maybe that's overemphasis to put it in a whole separate statement. Maybe the better place to put it would be as a schedule in the notes for most not-for-profit organizations. But by the way, if you have a fairly simple organization, and I say simple meaning not too many different type of functions, and I'll use a private foundation as an example only because they are major organizations, many of them, but they typically have only a couple of functions. Their functions are grant making, although I suppose they could have different type of programs depending on how they break it out. And then they would have administrative management in general. So they could, if they wanted to, do this entirely on their statement of activities, and they can have, under grants, they can break out the different types of expenses, and under management in general, they could break out the different types of expenses. So you don't have to do it in a separate statement, or do it in a separate schedule in the notes. You could do it all on the face of the financial statements if you have an organization that doesn't have a lot of function. We allow a lot of flexibility here. Put it in the place where it will be best to present it and gives the right amount of emphasis that you want to give to it. Okay? The other things that we did in the area of expense reporting is, in addition to that schedule or statement or better expanded information on the face of the statement of activities, again, to provide both function and nature, we also have some qualitative disclosure about the types of methods that you use to allocate costs among program and support functions. So is it done by square footage, head count, whatever you tend to use? I mean, we have some examples in the ASU that get to that. And we think that, combined with the information that's in that schedule or that statement or whatever, would give folks an idea about how costs are being allocated across organizations and how that is affecting the different things that they have in the different expense functions and how that affects ratios and things like that. We also took the opportunity to tighten and improve the guidance around what expenses get allocated out of, for example, the Office of the President or Finance or HR or IT or the other places where if you didn't allocate them, they would be under management in general. And so this is already a concept that's in GAAP, that in order to be able to allocate it, it has to involve the direct conduct or the direct supervision of these other activities, fundraising or program. So we reinforced that and gave some much better examples than we currently do. And we hope that that'll bring a little more consistency across organizations as to how they do those allocations. Right, unlike, for example, we have all this morass of stuff around allocations out of fundraising already in GAAP, and we weren't going to touch that. The last major area that we did some improvements on is the reporting of investment return. And right now under GAAP, you have your choice as to reporting that gross or net of expenses. Reporting something gross of expenses means you'd have the interest, dividends, gains and losses and all that up here, and you'd have your expenses down with the other expenses, okay? Reporting them net means that you'd have your investment return, and then you'd have your corresponding expenses below it to come to a net number, okay? You wouldn't have the expenses down with all the operating expenses and so forth. That caused a lot of inconsistency across organizations. So going forward, You would have to do net. That doesn't mean you have to do it in only one or two line items. You can put it in as whatever detail that you think might be useful. So again, to use the private foundation example, they might want to have a few different lines for the different types of investment income. And they might want to perhaps break out a little bit the investment return, investment expenses a little bit more, but they don't have to. You can do this in multiple line items. You could have a net return for your short-term operating investments up in your operating section if you do an operating measure, and your net return from your endowment type or long-term investments down in another section. The key thing is you have to have the revenue and the expenses, the revenue and gains and so forth, and the expenses adjacent to one another, or netted against one another. Again, you can do it in one line item, or you can show the gross amount minus the expenses to get you to a bottom line number for that type of investment group. Anyway, lots of flexibility here, but trying to bring some more consistency. There's all kinds of illustrations in our ASU. As part of this, we were able to do something I think which was a very good thing, which is we eliminated the requirement to disclose investment expenses that have been netted. Now you might say, well, what's the big deal there? Well, depending on what type of investment expenses we were talking about, that may or may not have been a very easy number to come up with, okay? Monies that you cut a check for, to pay your custodial fees or to pay investment consultants or whatever, those are pretty easy, right? Monies that you've put people's salaries, when you've attributed a piece of people's salaries to it, okay, those are things you can readily come up with. It might be, if you have a chief investment officer, if you're big enough for that, okay, you have that salary and then benefits and so forth. If it's a percentage of your CFO or your controller's time or whatever, that's numbers you can easily come up with. The part that was very difficult, if not impossible to come up with, is embedded fees in investment funds. So if you were in and out of all sorts of mutual funds, or if you're invested in hedge funds or private equity funds or whatever, forget the fact that those funds that you're getting reports on have different fund years often than your own fiscal year. You might be in and out of them all the time. So to try to figure out what portion of the expenses that were embedded within there actually would be things that you would disclose, I would argue would be a very difficult, if not an impossible thing to do. So we're moving that requirement entirely. You no longer have to do that, okay? We also have some guidance here about on internal expenses that you might net as opposed to the stuff you cut a check for externally. So pieces of people's salary and so forth. When is it appropriate to net it? And it really is the flip side of what we talked about a little while ago before with stuff going out of management in general, which is only if it involves the direct conduct or direct supervision of strategic or tactical activities involved in generating investment return, okay? So again, we're trying to make, whether you manage things in-house, out-of-house, or a combination of the two, trying to net the same kinds of expenses in both circumstances, okay? A lot of information there. I encourage you guys to take a look at this. I'll gladly answer any questions that you might have. We didn't address operating measures other than in this phase, other than to say if you use them, you need to be transparent about it. We have some guidance and some examples there as well. So when is this effective? This is effective for calendar year 2018, next calendar year if you're a calendar year organization, or fiscal 18-19, which is a little bit over a year away if you're a fiscal organization, a June 30th year end or a September 30th or something other than a calendar year end. You can early adopt this if you want. And there are some pieces of this you might want to get a head start on because a lot of this is actually already allowed under GAAP, and I have a slide on that right after this. When you do adopt this, normally under GAAP, when you do two-year comparative financial statements, Jeremy was talking about that before, you normally would provide footnotes and all for both years. But because we know that it might be a little bit more challenging on first adopting to do a couple of these things you don't have to do for the earlier year, the comparative year. And those two things are a schedule or a statement of functional expenses if you're not already doing one. If you're already doing one, we're not going to take away that information because you already presented that last year. But if you are a private foundation or a hospital or a university or a museum and you're not already doing that for GAAP purposes, you don't have to do it for the prior year. You just have to do it for the current year. And then the other area where we think there might be a little bit more work involved is that move the ball forward type of disclosure I talked about earlier with regard to the information about liquidity and availability of resources. So again, you'd have to do it for the current year, the year of adoption, but you wouldn't have to go back and create one for the prior year, okay? All right, so I spent a bit of time talking about this, this standard, and I did that deliberately because I know that many of you are interested in this. This is an important standard for not-for-profit organizations. I'd argue it's a once in every 20-year opportunity to work with Singer LUAC and others to help better tell your financial story. We think we've removed some impediments, made some things better, but work and take the opportunity to change things if you like, beyond that even. And why am I having trouble moving this? Yeah, I'm trying to get rid of that. So how do we do that? Hit escape. Okay, thank you for your tech-savvy people here. All right, so we'll take escape, and now we'll probably be able to move right forward, right? It's not on slide view, though, all right? Anyone want to help me just a sec? I'm just a little more tech-savvy than me. All right. Thank you. Let's see if this works. Good. I mentioned a little while ago, there's actually most of these things you could already be doing if you want. In many cases, we were just promoting some best practices, eliminating some options, and so on. So pretty much you can do anything that's already that I've been talking about in the last half hour, with the exception of 4 things that you can't do unless you actually implement the standard itself. And those 4 things are on the slide. You can't collapse your restricted net asset classes into one if you have both temporary and permanent until you adopt this. If you have endowment funds that are underwater, maybe not that many now as opposed to 2009 or 2010 or 11, you still have to show that deficit in unrestricted until you adopt this standard, in which case you move that to restricted with some better disclosure. You would still, if you net your investment return, you have to disclose your investment expenses that you've netted until you adopt this standard, even if it's a difficult thing to do. At least in theory, you're supposed to be doing that. And if you are brave enough to move forward to the direct method of reporting cash flows, you would still have to do that indirect method reconciliation until you formally adopt the standard. Anything else that I've talked about, you can do now. So, one way to approach this would be do a few things this year, and if you're a fiscal year end, maybe a few things the next year, and then they'll do in the last group, when you have to. There's all sorts of ways you can ease into this if you like. All right, so let me say a few things about the various other projects that we're working on and some other key standards. Grants and contracts to not-for-profit organizations. Why are we doing this standard, this project? Well, we have a new revenue recognition standard, which I'm going to talk about in a minute, revenue recognition of contracts for contracts with customers. And many people over the years on grants from government agencies have treated them as exchanges, as more or less contracts with customers. But we put into place this whole model on contracts with customers with all sorts of new disclosures, and that model was not intended at all for these types of grants where a government agency, in many cases, if not most cases, is not getting direct value back. They are not getting proprietary rights to things that are being discovered. They are not getting all sorts of other things that might come out of it. The sort of things you would expect in a contract with a customer. You're paying you're paying for what you think is getting equal value in terms of goods and services that are being given to you. And so many people have taken the view that a government agency is sort of representing the general public, and if the general public isn't benefiting in some possible way, then the government is benefiting, and otherwise we'd be doing the program itself. And therefore, these are exchanges and so on. But there's been some vague guidance in GAAP that's allowed people, at least people have used it to allow them to match revenue and expenses. That guidance went away with the new ASU. So the question really is, what stuff is within the new revenue recognition standard? What truly is a contract with a customer? When is the government really procuring things and getting equal value back? And when is it engaging in something else, which we'll broadly call contributions, but let's just call it non-reciprocal, non-exchange, whatever type of trend. There might be a public-private partnership involved here or whatever, but it's not that the government itself is getting direct value back. Now, so that's one issue we had to deal with here. The other issue is if you're going to put many more things potentially into the contribution or non-exchange bucket, we got to really improve the guidance right now that's in GAAP about what is a conditional contribution where you wouldn't recognize the money all up front even if in a different net asset class. But instead recognize it when those conditions are met, when you've spent the money for that purpose, when you have reached certain output targets or reached some outcomes, or an event has happened, or whatever it is that's the condition that the resource provider has attached to those funds. Again, right now it's very difficult to get to conditional, except for some real obvious things like matching situations or an outside event has to happen. But many people look at this and say, okay, I accepted the grant, it's in my control, all I have to do to spend it is spend it, and therefore I should be recognizing the revenue all up front. But that is not really what our board meant 20 years ago. They meant, similar to the RevRec standard, when is the not-for-profit entitled to the money? When would they be able to keep it? Or when would they be able to draw it down if they didn't get the money up front? It's not always the case. There are certain types of grants out there, especially from foundations that don't have these metrics and targets and all put in them. But the reality is that many other types of grants, especially in the last 10, 20 years, do have all sorts of output targets or outcome measures. Or if it's a federal or other state and local grant, you may have to incur qualifying expenses with under all sorts of cost principles and subject to audit and clawback and all the other stuff. There's lots of different barriers, and this is what our board meant 20 years ago by what's a condition, is there a barrier to be overcome, a hurdle to be met before you're entitled to keep the money or to get the money in the first place. So trying to improve the guidance around what's a condition and then distinguishing that, by the way, from what's a restriction is very, very important as part of this if we are going to put many more of these things out of exchange transactions and into this bucket, because they truly are not the kind of exchanges that we're now dealing with, which is contracts with customers for goods and services. So our board has made some decisions in each of these areas, and we will be coming out with a proposal. Probably we'll be issuing that proposal, my best guess right now is in early July. We'll have a 3-month comment period until early October, and then redeliberate this based on what we hear from you guys and others about, do you like this approach, what things need to be further tweaked, and so on. And then ultimately come out with some guidance in the first part of 2018, which is really important because we need to get this into place by the time that you start implementing that RevRec standard. Because the question is, which of these grants and contracts, particularly from government agencies, are in that RevRec standard, subject to that model and the disclosures and so forth, and which is in this new and what we hope is improved guidance for non-exchange, non-reciprocal, or contribution type transactions. So on that first question, the first question about what is within the standard and what's not within the standard, what we're going to be clarifying here, and there's a little chart here, is that most of the stuff will now go to non-exchange or contribution, or whatever you want to call it. The stuff that's going to be in exchange is when there is direct commensurate value going back to the government agency or other that's providing it, and we don't think there's going to be a lot of that. We think it's not like they're buying jet aircraft fighters from the not-for-profit sector and doing things like that. We think what you really will mostly have that is an exchange is not when the government itself is getting value directly back, but when the government is paying as a third-party payer for situations where the underlying customer is getting value back. So think about in a hospital setting, Medicare, Medicaid. Think about in the university, your Pell Grants. Think about maybe a government employee getting health care or getting tuition remission, whatever, through a university. In those type of situations, the grant itself, this money itself, is actually not new revenue. What it is it's a payment on tuition revenue or patient service revenue or the underlying revenue that that customer that's being recognized in connection with the service that that identified customer is getting, the patient in the hospital, the student in the school, or whatever that ends up being. That's the stuff that's in the exchange bucket, the reciprocal bucket going forward. Anything else is in the non-exchange bucket. So what we're going to be clarifying is a government is not synonymous with its citizenry. If its citizenry is benefiting, that doesn't mean the government is getting direct commensurate value back. A feel-good sentiment by a donor is not commensurate value. Furthering the mission of a donor or a resource provider is not commensurate value. So the key things are commensurate value is really the goods and services coming back to that government or other provider, or where they're paying it on behalf of an underlying customer who's getting goods and services of commensurate value. All the other stuff is in this other bucket. And so on this other bucket, what we're trying to do is to improve the guidance that was in there but is either being ignored or it's insufficient or inadequate, and that has to do with what's a condition. And what's a condition is it has to involve either a right of return being present, and when I mean a right of return, I mean that broadly to mean monies that have been given to you would go back to the resource provider, the government or whatever, if you don't meet these hurdles, if you don't meet these barriers, if you don't perform these services or whatever. Or if you haven't been given money up front, that resource provider would be released from their commitment to having to provide it to you, having to give you the money, okay? So a right of return or release from obligation has to exist, and it has to be either in the agreement itself, and we're going to be very flexible about the wording. It's, you know, you look at it and can you come reasonably to the conclusion that either that agreement or a related document, say federal cost principles or whatever, have that, you know, have that notion in it. Again, you know, to either return it or not be able to get the money in the first place. And then the second thing is that there has to be a barrier. And so we're going to have a bunch of indicators about what those barriers might be. And the indicators as a package would be, are there measurable outcomes, measurable outputs, things you have to do? Do you have to incur qualifying expenses under cost principles and all those other things? Does there have to be outside events that have to happen first? Do you have to reach a match? Or there's kinds of things like that. Many of which, some of which you already would be considering conditional, but many of which folks would say, they're under my control, so therefore they're not conditional. What we're trying to say going forward is those are conditional until those things match. And why it matters if it's conditional or not is you only recognize the revenue when the condition is met. Okay? And then there's a few other indicators too that we've put into that package. So going forward, this is our proposal. If you want to think of this as a set of 3 questions that you have to ask. The first question is, which standard is it under? Is it under the RevRec standard, or is it under this non-exchange contribution guidance? And so if it has transaction in which each party directly receives commensurate value, then it's reciprocal, it's under the RevRec standard. If that's not the case, then it is non-reciprocal and you apply the contribution or non-exchange guidance. The second question you have to ask is there a condition present? And again, the condition being present would delay when you record the revenue. You don't record it until the condition is met. And what we have here is an approved definition of what's a condition that revolves around a right of return or release from obligation and a barrier or a hurdle being present, and we have some indicators to help you come to that judgment. And then when something is either unconditional off the bat, or it becomes unconditional because the conditions have been met, then and only then do you deal with the question of, is there a restriction present? And the restriction question, which is a much simpler question than it might be now because people are kind of thinking about condition and restriction and all sort of jumbled together because we have really poor guidance on what's a condition. But when going forward, the question about restriction is how broad or narrow is the purpose of the time frame. If it's a broad purpose, then it's unrestricted. If it's for a narrow specific thing, it's restricted. If it's for the current year, it's unrestricted. If it's for a future year, it's restricted. Okay? So it's much simpler notion of what's a restriction going forward. Because the key thing here is to first determine, is there a condition or is it not? And if there is a condition, has it been satisfied? See, very important project. I hope you guys all weigh in on this when it comes out. Okay? So I'm going to now just go over a few quick things just to make some key points here on some other standards. I'm going to focus particularly on these first 2. Revenue recognition and contracts with customers. Jeremy and others, I assume many of the people in this audience have at least some familiarity about this big new standard because it affects public companies, private companies, not-for-profits. So what we have here is goods and services being provided to customers by public company, private company, not-for-profit organization. We now have a new principles-based model that applies to it. And it really comes down to, in a nutshell, you recognize the revenue when you've, as a resource, as a providing organization, a not-for-profit, a public or a private company, when you've delivered those goods and services and are entitled to payment. That's when you recognize the revenue. And there's a model that's all around that. So people will ask, okay, is this a really big deal for not-for-profit organizations? And my quick answer is, unless you're a healthcare organization, a hospital or whatever, this is not a big deal for most not-for-profit organizations. That's not to say there aren't a few things you may need to look at. And I'll tell you what some of those things are in a minute. Probably the new big thing is there are some disclosures in this area that have never been present before, and for most not-for-profit organizations, it's mostly some qualitative disclosures. But there are some quantitative disclosures as well, and whether you'd have to do some of the quantitative disclosures and frankly when you have to implement the standards depends on whether or not you are a public not-for-profit or not. And public not-for-profit for purposes of this, and I'm going to jump forward, means a state or local government has issued bonds on your behalf. You are obligated for those bonds, or you've issued debt on your own if you've somehow been able to do that, but not too many not-for-profits are able to do that. And it's traded out in the public marketplace through an underwriter or whatever. It's remarketed daily, monthly, weekly, whatever. If you're into this, you know exactly what I'm talking about. If you're not into this, then you probably are not a public not-for-profit. But anyway, if it's publicly traded like that as opposed to privately placed with a bank, and sometimes they are privately placed with a bank or an insurance company or some other one single party, okay? If you are a public not-for-profit, then you have to implement this a year earlier, which is 2018, same time as the not-for-profit standard. You get another year if you're another type of not-for-profit organization. And you have the fiscal years 1819 or 1920, again, depending on that. I said a minute ago that it's not a big deal for most not-for-profits. So if you're a healthcare organization, you have some challenging issues, and I'm not aware there's any healthcare organizations here. If you are from one of those, feel free to come up and we can talk right after this. If you're in other not-for-profit organizations, the things that I would be mostly focusing on, I think probably the biggest thing, is licenses of intellectual property. And the guidance that we've put out in follow-up on this will tell you, depends on the nature of the intellectual property. And I'll give you a couple of examples here. It distinguishes between symbolic intellectual property and functional intellectual property. So let's start with functional intellectual property. That means that it's something that right now you can hand it off to somebody and return for that license fee, and they can use it right now, and there's nothing more that you need to do. An example that I often like to give is pick a university. Let's say I'll pick one in the state of California, Stanford University. They have a medical school. Let's say they develop a new surgical procedure and they create a video of it so that they can license it out to other medical schools around the country, okay? They've created this video. Once they give it over, those other university medical schools can just show this thing. There's nothing more that needs to be done. It's everything. It's got all the functionality there. You know, it can tell them exactly what they need to know. That's an example of functional intellectual property, and that's the type of intellectual property you would recognize up front when you enter into the license agreement. The thing that it contrasts with is symbolic intellectual property. A good example of that, and I'll take a little closer university here, Gonzaga. Let's say Gonzaga licenses out its Bulldogs logo. See, I even knew that. That's Bulldogs logo out for mugs and sweatshirts and whatever else it licenses it out for. You might say, well, they've created the logo. Shouldn't they be just recognizing the revenue when they enter into the license agreement? No, because there's one very important additional duty, additional performance obligation they have to do, which is they've got to protect the value of that logo. And you might say, well, what's a big deal there? Well, I come from the state of New Jersey, at least that's where I live. I work in Connecticut. In an adjacent state to where I live, the state of Pennsylvania, you may be aware of a certain football program that had just a wee bit of difficulty several years back. That's Penn State, Nittany Lions, and all that sort of stuff. And so one could argue that at least for a few years, maybe the value of that logo, of the Nittany Lion, might just be a little less valuable for sweatshirts and mugs and things like that. Because, again, there may have been some negative publicity there. So there's an important sort of thing with this type of symbolic intellectual property, and good examples there besides logos are trademarks and brands and other things like that. And that additional duty, the additional obligation is to protect the value during the course of the agreement. So for that reason, because not everything was done up front, there is this continued duty, that's the type of agreement that you would recognize over the course, the revenue over the course of the license, okay? And I know some of the folks here, maybe you, for case CET or whatever, may have some of those types of agreements on both types. That area of intellectual property, which universities have, hospitals have, lots of not-for-profits have, that's where you perhaps may need to spend your most effort. As for the other types of things, besides the grants issue, which I said there's a whole separate project about, and again, forgetting about healthcare, yeah, there's tuition and fees, but for the most part, unless you're talking about some non-traditional courses that you're offering throughout the year that span semesters and all that sort of stuff, you're probably going to be recognizing your tuition and your housing revenue not very differently than you currently are. Your membership dues, yeah, as you have currently now, you'd have to break it out into how much of it is a contribution versus how much of it is a membership due, really. And then then beyond that, it's a question of, okay, the things that they're getting for their membership dues, are any of them significant enough that you'd have to separately track them as a particular performance obligation and recognize that apart from the rest of the membership due, or can you just lump it together and recognize it more or less as you've currently already recognized it? So what you can see from what I'm saying, other than maybe intellectual property, for most not-for-profits, this really isn't that big a deal. And I know I'm almost at my time, but so let me just give you a couple quick more points, and then I'll open it up to some questions. So leases. The key thing here, and this is going to affect lots and lots of not-for-profit organizations. I know many bankers are very interested in this standard. What we're doing going forward is that all leases except short-term leases less than a year, where you have an option not to do this, will now be on balance sheet, okay? They will be on balance sheet from the lessee perspective, as opposed to currently right now you distinguish two different types of leases, an operating lease versus a capital or financing lease. Operating lease is off balance sheet, just in your footnotes, and a capital or financing lease is on balance sheet. Going forward, for purposes of the balance sheet, they're all on balance sheet. So basically what you're doing with all these operating leases going forward is to take what would be in the footnote to your financial statements, discounting that to present value, and then updating it once a reporting period, once every year end or whatever, however frequently you're giving your GAAP financial statements to your lenders or whatever, to discount it back to present value. So basically what you're doing is you're putting what would be in the notes on the face of the balance sheet. Now, otherwise, what you will see is basically no change. I know that's a big change, but there's no change otherwise. What you would do during the course of the year, and this is very important, is for operating type leases, you would recognize it as lease expense, straight line rent, like you currently do. If it's a capital or financing lease, and there's the same criteria for distinguishing between the two, you would recognize it as interest and amortization expenses, and your interest expense would be front-loaded just like your home mortgages. Those of you who have capital leases know that now. It's no longer a question of the on-off balance sheet switch going forward is no longer, is it a capital lease or a finance lease or an operating lease? It's, is it a lease as opposed to a service agreement? And there's all sorts of guidance in there giving examples about when something really is a lease, meeting the definition of a lease, and when it is a service agreement. The one other point that I want to make for a not-for-profit audience like this is the definition of a lease, those words. A lease contract conveys the right to use an asset for a period of time in exchange for consideration. Those very last few words is very important. So donated use of space or donated use of equipment or whatever, or nominal like $1 a year is not within the standard. It might be within the contribution standard, but not within the standard. We're talking about when there is consideration for it, okay? Not much changes on the lessor side, and this is effective 1 year after the revenue recognition standard, using the same public, non-public cut. So public not-for-profits, as I described a little while ago, go in 2020 calendar year, 2019 calendar year, 2020, 1920 fiscal year, and then 1 year later for all other not-for-profits. There are a few other ASUs that we've put out. I have some information on the standards, on those standards in these slides. I encourage you to take a look at them and email me or call me with any questions that you might have. They have some key points in there, which I think are pretty self-explanatory from the slides. But I wanted to make sure that I covered the really important things that you'll either need to be implementing or that you'll need to be weighing in on in the near future. So with that, I wanted to see if anybody had any questions. Yeah, thank you. Okay. So the question is, under the new net asset classes, what will underwater endowments look like? You will no longer have this negative amount sitting off in unrestricted. Your entire endowment will be together in one lump in net assets with restrictions. When you do your notes or your breakout on your financial statements, you will have donor restricted endowment fund probably on a line of some sort, okay? And where you will be able to see the underwater piece with a lot more context around it is in the footnotes. So in the footnotes, you will have to put cumulatively for those funds that are underwater, not fund by fund, but let's say you have 3 funds that are underwater. For the 3 of them together, what was the original donor gift? What was the fair value? What's the fair value right now? And what's the difference, which is the underwater amount? So you have some context around how relatively underwater you are. And then there's some policy type disclosure where you put your investment and spending policy about if you have a policy in place or if you've taken any actions around spending from underwater endowments, what is that? Okay? So that's what it would look like under the new standard. So the question is, does that force people to come up with policy? The answer is no. It is if there is a policy or if there is actions that are taken, but I would hope that in terms of good governance, you'd probably be doing it anyway. Certainly, what I had, in the aftermath of the financial crisis in 2009 and 10 and 11, there were certainly a lot of boards out there that had a lot of these new gifts that were really underwater, taking some significant actions about suspending, spending less, or even in some cases, maybe even spending more because they desperately needed it otherwise. MIFA allows you some flexibility, but we're just asking for some transparency around how you implement that flexibility. Again, this is already best practice. We hope that this will be more widespread practice now. Other questions? Yes?
I may be one of those people that's kind of lost in between conditions and restrictions.
Good. And there's good reason you are, because we have bad guidance.
You talked about that in the context of customers and contracts. Are donors ever in that category, or is a donation something that is treated separately from that standard?
Okay, very good question. There is a slide that I went through really quickly. I actually sort of glanced over it, that contributions or donations are not within the RevRec standard, okay, because they're not a model where there's reciprocity, exchange of goods and services for consideration, which is what that whole RevRec model is about. It's a customer-provider relationship. So, and I would argue, from my old days, I would argue that I would categorize a donor as opposed to an ultimate beneficiary more as an investor than a customer, frankly. They're investing in something for the community good, okay? Now, that's with regard to a pure contribution. Where there's confusion is on a grant, particularly, and especially if the grant is from a government agency. There are many people out there who would have, in the old days, or even now, would say that that is an exchange. But going forward, there's a much tighter look at what's an exchange here with this new RevRec standard. It's not really an exchange. So if you're going to put it into a non-exchange bucket, whether you call it a contribution or not, and we're going to ask about terminology here, because I know there are people who can't say government and contribution in the same sentence. By the way, just amusement here, if you bear with me for a second. I chair our not-for-profit advisory committee at the FASB. When we said this, when we made that statement at one point, there actually was somebody at the table who says, just like you can't say Trump and president in the same sentence. Be careful what you wish for, right? But if you're going to put more of these things into a non-exchange or contribution bucket, and you don't want to recognize government grants all up front, that would be ridiculous, right, for most of these circumstances, you got to beef up what's a condition. So what we're trying to do is now put into place better guidance, better examples, better indicators, and all the other stuff that we didn't put into place 20 years ago about getting people to a condition, a barrier, a hurdle, so that in many cases, they will not recognize things until those barriers are met. Just like, by the way, on the RevRec standard, they won't recognize until the goods or services are delivered. It's somewhat parallel here we're talking about. And then, once they recognize it, because the condition's been met, then the question of whether it's a restriction or not becomes much simpler. Because right now, because we have really poor, I almost put a word before poor, guidance on what's a condition, people, of course, confuse what's a condition versus a restriction, because people don't know what a condition is, okay? Again, going forward, restriction is just how broad or narrow it is with regard to purpose or time frame. Anything else is a condition, basically. So I hope that will really help a lot. Okay? Other questions? Yes?
The section on leases, is that just on equipment? Or
No.
if a nonprofit engages in leasing a building
Oh, yeah.
10 years?
That's where the bigger numbers are. So the question is the leases standard just on equipment? No, it's on leases of all assets. And the definition of a lease is the right to use an asset for a period of time in return for consideration. In fact, the bigger dollars are often, I know hospitals are into major medical equipment and so forth, but the bigger stuff is really on the office leases, right? Or a manufacturing plant or whatever it is. So no, what my key point again there was whether it is, regardless of the type of asset that we're talking about, if it is a lease as opposed to a service agreement, again, that's the new tension point. Is it a lease or not? Then it's on balance sheet unless it's really short term, and the only difference between an operating lease and a finance lease or capital lease going forward is really how it flows through the statement of activities. As a straight line rent, if it is an operating lease, or as interest and amortization front-loaded if it is a capital or financing lease. It's no longer an on-off balance sheet switch anymore. So you may have all sorts of structuring going forward, but it won't be to meet operating versus capital. It'll be, can I turn this lease of major medical equipment into some sort of service agreement or something like that? That's the kind of structuring, if any, that you would have going forward.
So when I look at a non-for-profit's income statement, like in 2 years, I'm not going to see a lease or rent expense on the P&L?
Not at all. Not all meaning yes, you will, okay? The income statement or statement of activities is going to look no different. It's going to have still rent expense or lease expense for operating leases. For capital leases, it'll be interest and amortization. What will be different is the balance sheet will look very different. The balance sheet is going to have bigger assets and bigger liabilities. We're not calling that liability a debt, and we'll see how bankers interpret that as a debt or not. But that's going to be in lieu of the information just being in a footnote. It's going to be now on the balance sheet discounted back to present value, okay? What we're really doing with the leases standard is essentially, are you a banker? You work with bankers, okay. What we're doing is essentially standardizing the measure of leverage. Right now, bankers sometimes take into account leases, sometimes don't. If they do take it into account, it might be a multiple of rent. It might be 6 times annual rent or 8 times annual rent. No longer do we have to have these proxies. It'll be essentially based on the leases that are actually in place, discounted back to present value. So they'll have better starting point information, what I call standardizing a measure of leverage to reflect the leases that are actually there. Question? Of course. Yeah. Yeah. And that's the key question that your auditors and all and your bankers will be working with you on. Now, yes, and that's going to, this issue is the issue, internationally they have a standard that they just put into place. Nationally, this standard applies to public companies, private companies, not-for-profits. The whole world will have this new situation. So yes, it will certainly, it could affect your bank covenants, but I say could because it might not affect your bank covenants if, for example, and this is of course assuming you still have a loan that's actually outstanding at that time, it might not affect it if you have a pure accounting change doesn't affect things. And I hope more and more people will get that negotiated into their loan agreements going forward. That it's pure accounting change as opposed to something that really happened economically, that shouldn't affect your covenants. Now, many organizations have that, many do not have that. If they don't have it there, it'll depend, what the effect will depend on how your banker currently is factoring in this or not. Are they putting something in? Are they putting in some multiple of annual rent or not? Or are they not factoring it in? You might actually have some situations where this number might be less than the number they're using. If they're using 8 times annual rent and that's a higher number than you end up getting here, well, you actually will have lower leverage. If they're using some other number and this is a higher number, then you'll have greater leverage. So the effect will depend on what kind of covenants you have in place and how your bankers are currently using it. Yeah. Well, possibly, but just keep in mind that, again, we did not define this as debt. We defined it as an obligation, certainly, but we didn't call it out as debt. Now, how they interpret it and how the regulators interpret it, and I don't know the answer off the top of my head, and I'm not sure that's actually even been worked out, we will see. But I would hope that they'd be factoring some of that in anyway, because this is, the agreement is the same as it ever was. It's just now it's on the balance sheet and the measure of leverage is standardized.
We have time for one more question.
Yep. And again, you have my contact information. Please don't hesitate at all to email me, write me, email me, phone me. I love responding. Other questions on any of the things I covered? Yes? My view. I would say very narrow gifts. So like say you get a gift for a capital type thing, or you get a gift for, again, I don't know how often this happens, but a very specific program in a country you never otherwise would be in. It's got obviously a lot of judgment involved. I would try to be fairly expansive, but if there are some situations here and there, and certainly things for future years that would be more than a year out, because remember, it's general expenditures within the next 12 months, within the next year. So there's two tension points there. Is it within the next year? And secondly, how do you view general expenditures? I'm saying that we illustrated it by the way we illustrate, if you go to the ASU itself, it shows backing out all restricted, but we've since had more discussion about that, and we've actually had public conversations that said basically, look, we didn't define general expenditures, so as long as you're transparent about it, about how you're viewing it, there should be some flexibility here to how you present it. The goal of that disclosure, including all the qualitative information, is again, better starting point information. We're not trying to come up with some magic liquidity number. We're just trying to come up with better starting point information. So how do you put it in a way that best communicates to your bankers and your others who are looking at that information that could serve as the best starting point for such a discussion?
Okay, thanks, Jeff, for flying out to Los Angeles for this.
My pleasure.
We're going to take a 10-minute break. We'll start up again at 11 o'clock, so if you need to check your email and whatnot, and then we'll have two speakers give a regulatory update on the nonprofit sector.
Great. And I'll be around during this break, so if anybody didn't want to ask me a question in front of everyone else and wants to come up, and we can talk.